Welcome back to the channel. Today, we're diving into one of the most overlooked truths in investing, a truth that Wall Street and mainstream financial media rarely want you to understand. Most investors make a critical mistake. They treat every market the same, whether stocks are dirt cheap or ridiculously expensive. They follow a cookie-cutter investing approach, unaware that this is essentially financial self-sabotage. In this video, I'm going to reveal a simple framework that works across decades of market data, and you can use it immediately, without guessing, without complex charts, and without trying to time the market. By the end, you'll know exactly how to match your investing strategy to current market conditions, avoid unnecessary risk, and maximize your long-term gains. So, grab a pen and paper if you need, because this is actionable advice that could change the way you invest forever. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Here's the problem. Most investors completely ignore market valuation. Instead, they invest in the same way every single time, regardless of whether stocks are priced attractively or ridiculously high. Think about that. Buying the same way when the market is cheap and when it's expensive is like playing Russian roulette with your money. And yet, this is exactly what happens over and over. The financial industry doesn't want to tell you this because predictable investor behavior generates predictable fees, which keeps brokers happy. But there is a smarter, data-driven approach. It doesn't rely on gut feelings or guessing the next market move. It relies on observable reality, a valuation framework that has proven itself over decades. The tool at the center of this framework is the Schiller CAPE ratio, also called the cyclically adjusted price-to-earnings ratio. It's not some fancy secret. It's freely available online and takes less than a minute to check. What it does is simple. It compares the current price of the market to the average earnings over the past 10 years. This smooths out temporary spikes and dips, giving you a more realistic sense of whether stocks are cheap, fairly valued, or dangerously expensive. Historically, the CAPE ratio averages around 16 or 17. When it's below 20, the market is reasonably priced or undervalued. When it's above 30, you're entering very expensive territory. And when it surpasses 40, you're dangerously close to bubble conditions, the kind of levels seen before catastrophic crashes. Here's the actionable part. Before investing a single dollar, check the CAPE ratio. Then adjust your entry strategy based on the current reading. If the CAPE is below 22, the data suggests the market is attractive. In that case, consider upfront investing most of your capital, say 75% immediately, and spread the remaining 25% over 3 months as a small safety buffer. If the CAPE is between 22 and 28, the market is moderately valued, so split your investment. 50% upfront, 50% dollar cost averaged over 6 months. And if the CAPE is above 28, the market is expensive. Here, heavy dollar cost averaging is wise, perhaps 30% now and 70% over the next 12 months. This isn't market timing, it's market awareness. You are adjusting risk according to observable reality, not guessing the next crash or rally. Let's look at a real example. In March 2020, the COVID-19 pandemic triggered a global market collapse. Fear was everywhere, yet the CAPE ratio was sitting around 24, not extremely cheap, but not absurdly high either. SCHD, a popular dividend ETF, fell from the high 30s to the low 20s in pre-split pricing. After the 3-for-1 split in October 2024, that translates roughly from $12 down to $7 per share. Now imagine you had $50,000 to invest. Scenario 1. You invest the full $50,000 upfront at around $7 per share. You end up with 7,000 shares. Scenario 2. You dollar cost average that same $50,000 over the next 12 months. Both approaches eventually make money, but by late 2024, the upfront investor has dramatically outperformed. Why? Because they captured the entire recovery rally immediately, while the DCA investor kept buying at higher prices as the market recovered. This is a classic example of why, in reasonable valuation territory when fear is high, upfront investing wins. Now let's flip the scenario. November 2021. Markets are at all-time highs. Meme stocks are soaring and everyone feels like a genius. CAPE ratios were above 35, expensive territory. SCHD traded in the mid-teens pre-split, and valuations were stretched across the board. That same $50,000, if invested as an upfront, now becomes risky. 2022 brought soaring inflation, rising interest rates, and significant market declines. SCHD fell roughly 37% pre-split. The upfront investor faced a brutal loss, while the dollar-cost averaging investor, who spread investments over the year, experienced smaller declines and preserved capital. This shows that DCA isn't a bad strategy, it's just context-dependent. Here's an uncomfortable truth. Financial advisors originally promoted dollar-cost averaging not for investors' benefit, but to generate commissions. Mathematically, upfront investing has historically outperformed DCA in the majority of market conditions. But terrified investors are predictable, and predictable investors pay fees. DCA only makes mathematical sense when valuations are dangerously high. Yet most advisors will never admit this because it contradicts the "you can't time the market" mantra. In reality, strategically delaying entry when the market is expensive is a form of timing, and it works if applied systematically. Here's the simple decision-making framework you can follow right now. Check the current Schiller CAPE ratio. Compare it to historical averages. Remember, below 20 is cheap, 28 is moderate, above 28 is expensive. Match your entry strategy to the valuation tier. Use upfront or DCA as appropriate. Execute immediately once you've made the plan. Analysis paralysis is your enemy. Enable automatic dividend reinvestment. This step is non-negotiable. During market downturns, dividends buy discounted shares. During rallies, they continue compounding. Over a decade, reinvested dividends can add 20 to 30% to total returns. Here's the psychological reality that rarely gets discussed. Mathematics may favor upfront investing most of the time, but humans are emotional, not mathematical. If investing upfront would trigger panic selling during a downturn, dollar-cost averaging is a better choice, even if it's mathematically suboptimal. The strategy you can realistically follow for 10 years without deviation will outperform a theoretically perfect strategy that you abandon in fear. You will never buy the absolute bottom, nor sell the absolute top. Accepting this fact is critical to long-term success. The ultimate wealth-building formula is simple. Combine valuation-based entry, consistent dividend reinvestment, and long-term holding. No complex stock picking, no active trading, no guessing the next market crash. If you buy SCHD or a similar dividend ETF and reinvest dividends over a decade, you will almost certainly outperform investors trying to time the market. History proves it. Markets cycle between fear and greed. Disciplined, patient investors consistently capture wealth from emotional, reactive traders. So here's the takeaway. Applying a valuation-based strategy is not optional. It's essential for consistent, long-term investing success. Stop chasing perfect timing, ignore short-term noise, and match your entry strategy to market conditions. Activate automatic dividend reinvestment, stay invested through market cycles, and focus on decade-long growth rather than monthly fluctuations. Wall Street won't tell you this because it doesn't generate fees, and financial media won't promote it because it's boring. But it works. Patient, disciplined capital always wins. Your choice is simple. Use this proven framework to systematically build wealth, or ignore valuation entirely and leave your financial future to luck. One path is strategy, the other is gambling. Choose wisely. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.